Welcome to the Investing Insights podcast from Morningstar.com. Christine Ben's Portfolio Makeover Week is coming this fall. To be considered for a portfolio makeover, email portfoliomakeover@morningstar.com. Include your age, life stage, and some details, concerns, and goals for your portfolio. This week on the podcast, it's Ford versus GM dividends, Russ Kinnell on a 401k milestone, Patricia Oe discusses Vanguard's tax-managed balanced fund, Elise Glink on investing in real estate, Baird's Mary Ellen Stanek analyzes the bond market, and a medalist upgrade for JP Morgan small cap equity. Let's get started. Dave Whiston analyzes Ford and GM.
GM and Ford show up on dividend investor radar screens with dividend yields of over 4% and 6% respectively. Ford also pays a supplemental dividend once a year, which when added to its regular quarterly dividend comes out to an annual yield of 7.7%, using the most recent special dividend of 13 cents per share paid in March. Yields this high, especially in Ford's case, suggest the market is fearing a dividend cut. But I think both are safe because the market still does not believe that GM and Ford are different than how they or their legacy firm, old GM, operated prior to the Great Recession. I do stress to clients, however, that I don't expect dividend growth from either firm anytime soon, most likely not until after the next recession. Both management teams want a dividend that is sustainable throughout a cycle, so that is why both dividends have remained flat for a few years now. So let's talk about Ford first, since its yield is higher. The company ended second quarter with $25.2 billion of cash and investments outside of its finance arm, with 86% of that held in the U.S. Ford also has about $11 billion available on credit lines. Given that the annual regular dividend is about $2.4 billion, we see this liquidity as more than sufficient to keep the dividend safe. But we do think the firm could take a break paying a special dividend when a downturn occurs. The question, of course, is can Ford keep the regular dividend in a recession while also paying out at least $7 billion in cash restructuring over the next 3 to 5 years per its July earnings release? We think it can because the company's liquidity, excluding Ford Credit, is already over $6 billion above the firm's long-term target of $30 billion, which gives it a buffer to burn cash in a recession. More cost savings are coming via further platform reductions down to 5 modules from 9 platforms presently. There's $25.5 billion of cost cuts identified through 2022, primarily in materials, engineering, and marketing, as part of CEO Jim Hackett's emphasis on making Ford more physically fit. And the company's U.S. product lineup is finally getting updated soon. Next year and in 2020, new generations of high-volume, profitable light truck models such as the Escape, Explorer, and F-150 launch, and Ford enters new segments such as a compact off-road vehicle to rival Jeep, and also brings back the Bronco. These moves and others will bring Ford's U.S. portfolio average age down to 3.3 years by 2020 from 5.7 this year. Concentrating more dollars where it makes the most profits in light trucks should help results over time and help Ford maintain its dividend. There's 2 other reasons we think Ford's dividend is safe. One is a practical one, in that we feel the Ford family, which always has 40% voting power through super voting shares, wants its dividend, as do many outside shareholders. The second reason is the captive finance arm, Ford Motor Credit. CFO Bob Shanks this year, in interviews and on earnings calls, has said the credit arm's June 30th managed receivable balance of $151 billion is nearing a ceiling management has for the division of $155 billion. This means the captive is in a position to make distributions back to the parent. This year, the captive expects to pay Ford about $2.5 billion, compared with $406 million last year, and Shanks is guiding to a typical annual payout of about $1.6 to $1.7 billion. That payout alone is nearly 70% of the regular dividend each year. So we think even in a downturn, Ford's regular dividend is safe, but I would not be surprised to see the supplemental dividend cut or eliminated in a downturn. Now, despite Ford's higher dividend yield relative to GM's, I like GM stock more than Ford. Ford stock is slightly cheaper on a price-to-fair value basis, but until management better articulates its strategy, I think the market will remain frustrated with Ford stock, even though I think it's quite cheap. So investors will likely be waiting a while. GM, on the other hand, is in the midst of a $14 billion buyback program, which we like a lot because we think the stock is cheap. It is ahead of Ford in autonomous vehicle launch targets by 2 years, and it is just launching its new full-size pickup truck platform. This platform is GM's most profitable vehicles because it is also used for full-size SUVs, a segment GM dominates with about 2/3 of the market via offerings such as Escalade and Yukon. New generations of pickups and SUVs, with GM competing in more pickup areas than it used to, with re-entry into medium duty, and the new Silverado offering 3 new trim packages in high volume and off-road segments, and a crossover lineup just updated last year, leaves GM in our view with a very attractive product lineup right when American consumers are now buying nearly 70% light truck models every month. As for the dividend, we think that's safe too. GM keeps the vast majority of its cash in the U.S. The annual dividend totals about $2.1 billion, and GM has total automotive liquidity at June 30 of $32.1 billion, including $14.1 billion on credit lines. In a 2-year recession with a 25% U.S. industry sales decline over 2 years, for perspective, the Great Recession was a 35% decline for 2009 versus 2007. Management guides to a free cash flow burn of over 2 years of $1 to $5 billion, which is in line with our own projections. We see a lot of upside still coming to GM that the market ignores for now because we are late in the economic cycle. But we think in a recession, the market will realize management isn't kidding when it says GM North America can break even at 2009 industry sales levels, which were really a depression for the auto industry in our view and not likely to repeat. Both GM and Ford offer attractive dividend yields, but we like the GM story more than the Ford story right now. If GM can prove to the skeptics that it is a different company, then we see PE multiple expansion after the next downturn, higher than the roughly 6 times the stock trades at now. If that expansion occurs, then something in our view like 8 or 9 times forward earnings is not unrealistic, which at a conservative EPS of $6 per share means about 45% upside to where GM trades today.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, Russ Kinnell's blueprint for a $1 million 401k.
Hi, I'm Christine Benz for Morningstar.com. How can you amass $1 million in your 401k? Joining me to share some wisdom on crossing that threshold is Russ Kinnell. He's Director of Manager Research for Morningstar, and he's also editor of Morningstar Fund Investor. Russ, thank you for being here.
Glad to be here.
There's been a lot of discussion recently about amassing $1 million in a 401k. And on the one hand, you've got people saying it's demoralizing. On the other hand, you've got people saying, well, you've got to really take big risks. You argue that people don't have to do either. They don't have to be demoralized, nor do they have to take big risks.
That's right. You need patience. You need time. You need to let it compound. You need to hit your targets, but you don't need to take crazy risks. And you can see this. There are calculators out there for 401k, and you can see even with a modest return assumption, you can get past $1 million. You don't need to take crazy risks like put all your money in emerging markets or put all your money in 2 stocks or Bitcoin. No, you can do it through plain old equity and bond funds, but you do need patience and you do need a plan.
A key point you make, though, is if you are earning matching contributions, and most people are on their 401k plans, that you should really, as a first step, make sure that you're maximizing that match.
By all means, I think you really want to get the max that you can. That starts around $18,500 right now. Is the max contribution in a year.
$24,500 if you're over 50.
Right. It pops up over 50.
Right.
So you really want to get that because you're compounding it tax-free. But also, I think it's a good vehicle because it's one you really can't touch or it's difficult to touch. So it's a good discipline for us. It's a good discipline because we're investing every paycheck. So there are a lot of good things going on there. Obviously, if you're just out of college, you may not be able to hit that right away. But I do think you want to strive towards that and even start contributing to it, even if you've got student loans to pay off. You can be working on both of those, and obviously you want to make progress on both.
Right. Another point you make is to be careful with fund selection and really focus on the low-cost products. And certainly a lot of your research over the years has pointed to the virtue of keeping costs low in terms of fund selections.
That's right. So some people said you have to take crazy risks, and I don't think that's at all true. I certainly didn't. I had a very diversified portfolio. It was all mutual funds. There's no company stock. And a bunch of mutual funds too. So it wasn't just one fund that propelled me. So I think you want to have diversification, but you also want to have low costs are really crucial. We don't know the next 10 years could be a low return environment.
Right.
So you really need those low costs. And again, remember the 401k is a very long running proposition. You could be in it for 40 years or more. And so those low costs compound over time to a very meaningful level. So low costs are important. They also give you a little margin for error. Maybe you picked the wrong stock picker, maybe you leaned a little the wrong way on your allocation plan. Low costs are going to help to make up that ground.
So a follow-up question, though, is some people are not in low-cost 401k plans. They might have a small employer, and that plan may in fact be high cost. What's your advice to them?
Yeah, so obviously I think then it's less appealing. If you've got a match, it's probably still worth it because again, if you've got a 50% return and from the get-go, and even if you're, let's say, spending another 60 basis points above average, that's not great, but it's still worth doing. But obviously then I think you certainly want to also keep an eye on building up your portfolio outside that 401k. And if I had a high cost 401k, I'm sure I'd be even more focused on low costs outside that. I'd really be pushing the limits on really low cost funds outside that. But yeah, generally it's still worth it. And obviously, to the degree you can, it's worth letting management of your company know that
it's pricey.
It's pricey. There are a lot of lawsuits out there. The company's at risk as well as making their employees unhappy.
Yeah, and one thing we've seen is that more and more index funds are appearing in 401k plans. So even if they're not the cheapest of the cheap, they're usually the cheapest thing on a given 401k menu.
Index funds and institutional share classes are really growing in 401ks, and well-run companies are doing a good job of taking advantage of that and can really keep pushing costs lower in their 401k funds.
Okay. Another point that you made in the article, and you hinted at it just now, is this idea of the fact that the market environment that we've enjoyed over the past decade may not repeat itself over the next decade or so. So you think patience is really important for 401k investors who want to try to amass a sizable sum in their accounts?
For sure. I mean, you may remember about 10 years ago, we were all talking about the lost decade. People right. In the aughts didn't really make much of a return at all because you had two bear markets in it. And that looked dismal. But on either side of it, it turns out we had tremendous bull markets. And the way you make money in your 401k is sticking to your plan through thick and thin. And so it's tough. But I think maybe the one way I could have wrecked my plan is by panicking in one of those bear markets and getting out, because of course you're never going to get back in at the right time. You're going to miss out. So just stick to your plan. 401ks have nice things like rebalancing features that will rebalance for you, which is great, so that you don't let your plan get too out of balance.
Right.
But I think you really want to stick to your plan. You really want to be patient. You need to remind yourself that this is money for my retirement. This isn't money for now. This is going to work out.
Okay. And I guess a related point maybe gets back to diversification is the idea that there will always be something in your portfolio that you're sort of like, what is this here for? Like maybe it's been bond funds for investors over the past decade, but you'll be glad you have them going forward, right?
Exactly. That's what diversification is really about, is smoothing that ride out. But also the fact that calling assets is really hard. With hindsight, it looks really easy. But in reality, it's very hard. Right now, emerging markets look lousy, bonds look lousy, but maybe the next 10 years, they'll be the ones to lead. So yeah, I think diversification is really important, not just by asset class, but by fund. Spread your bets around, and that's going to work out well.
Okay. Last point, Russ, is for people who feel like they are really amassing significant sums, whether they've hit this $1 million threshold or not, you think it's important that they don't rest on their laurels. What do you mean by that?
Yeah, the 401k is one piece of your investment plan. There can be many more, obviously, investments outside your 401k, IRAs, insurance, maybe you've got a pension.
Right.
You need to look at all of that, and you need to look at your likely costs over life and see how all that works together. Either build a plan yourself or with help. So the 401k is one piece of that. If you're wealthy, you may have higher spending ambitions, so you're going to need more than the $1 million 401k. Sounds nice, but it actually is not the whole piece. There's obviously things like long-term care, insurance, all sorts of things that you want to factor in to develop a complete plan. This is one piece of your plan. Look at it all together and adjust accordingly.
And taxes come out of that $1 million, so people need to set expectations on that front too.
That's right. If you're 40, you know that the amount in your 401k is going to change, so it's probably going to be worth a lot more when you retire.
Right.
but then you're going to pay taxes. So you don't know exactly what your 401k is going to be worth when you retire, because there are some big changes going on. You're going to have appreciation, we hope, but you're also going to have a tax bill. So factor those things in too.
Okay, Russ, thank you so much for being here. Always great to get your insights.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.com.
Can your portfolio weather the market? Use our premium portfolio tools to identify risks and streamline your holdings. Get started today with Morningstar Premium.
Next, a set it and leave it option from Vanguard.
Vanguard Tax Managed Balance is a cheap, tax-efficient, set it and leave it fund and carries a Morningstar analyst rating of gold. This 50% equity and 50% bond fund is comprised of gold-rated equity fund Vanguard Tax Managed Capital Appreciation and silver-rated muni fund Vanguard Intermediate Tax Exempt. The equity sleeve slightly underweights dividend payers to reduce taxable distribution, and the managers opportunistically try to harvest tax losses. And despite those tweaks, however, its performance has remained very close to that of the Russell 1000. On the bond side, the team seeks to manage a high-quality muni portfolio, and currently over 70% of its holdings are rated AAA or AA. And since the fund's inception in 1994, it has not made a capital gains distribution, and its 10-year tax cost ratio of 58 basis points is significantly below that of its peers, which is 120 basis points. Investors can replicate this balance fund by holding its two underlying funds, but may incur some capital gains when they rebalance. The fund has to maintain at least a 50% allocation in its muni bond sleeve so that it is able to pass through the federal tax-free distributions. As a result, this fund's allocation of 50% stocks and 50% bonds is slightly more conservative relative to a standard 60-40 balance fund. Over the trailing 5 and 10 years, the fund's returns have remained within the top decile relative to its 30% to 50% equity allocation peers. With a lower tax cost ratio and a 9 basis points fee for the Admiral shares, this is an attractive option for cost and tax conscious investors.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now, Elise Glink on the pros and cons of real estate investing.
Hi, I'm Christine Benz from Morningstar.com. How does real estate stack up as an investment? Joining me to discuss that question is Elise Glink. She's CEO of Best Money Moves, and she's also author of a new book, 100 Questions Every First-Time Home Buyer Should Ask. Elise, thank you so much for being here.
It's a pleasure.
Your new book is geared toward first-time home buyers, but you have done a lot over your career on the topic of investing in real estate. And I want to talk about that for our viewers. Many of them are avid investors in stocks and funds and exchange-traded funds, but they might be considering some sort of investment in real estate, in actual physical property. So let's discuss the benefits of such an investment.
Well, one benefit is the new tax law, right? So things that are no longer going to be deductible are not as limited when it comes to investing in real estate. And so a lot of the way that you deduct those costs and expenses and account for the income, I think, is going to be favorable to taxpayers. And so you may want to look at that just as a little aside. But retirees are increasingly looking at investing in real estate as a way to augment retirement income and to leverage some of the other expense and time that they have available. So I'm getting to thinklink.com, which is my website for the book and for my other real estate stuff. I'm getting a lot of interest from people who are in their 40s, 50s, and 60s asking basic questions about investing in real estate. And I cover some of that in the book as well, because they're familiar with the process of buying, but what they're not familiar with is thinking about how investments in real estate actually work. They're not familiar with the tax laws, how things get accounted for. They may not realize all of the great deductions that they get, and they may not realize that when they sell the property, there's a way to defer any gains on that property if you roll that into a new investment with a 1031 exchange. So There's lots of different opportunities and ways to splice and dice.
Okay, so naturally people are attracted to this idea of if I have this property that I can rent out to someone, especially if I'm getting close to retirement, it's a way of kind of augmenting whatever income I have from my investment portfolio or that I'm getting from Social Security or a pension. So that's obviously a big attraction. Let's talk about some of the drawbacks though. Everyone is not cut out to be a landlord, right?
Oh my goodness, no. And my husband and I talk about this all the time because we have a couple of investment properties and I just know he would love to get rid of them. And he's a real estate lawyer, so he's the perfect person to help manage it, but it's just one more thing to do. And so when you're in your 40s and even 50s, you typically have, either school-age kids or they're a little bit older, they still require a lot of time. You've got your partner or your spouse and that requires time. Work by this time is getting, a little bit more, and it becomes yet one more thing to manage. On the other hand, I have, people who have reached out to me over the years when I've talked to them about it, and they've come back 10 years later and now they own 25 properties. And so they see an opportunity. This is how it all starts, right? You see an opportunity near where you live and you think to yourself, wow, that house is in really yucky shape, but the bones are good and I could probably fix that up and rent that out. And all of a sudden, without even looking at it, you've bought that house and now you're in the process of doing it where you're going to learn a million lessons.
Right.
It's not as easy as it looks. But if you stick with it and you're thoughtful about what you spend and what you charge and you do some homework, it's a very nice way to augment retirement income.
Okay, so I guess another thing I think about though is in addition to maybe some of the maintenance responsibilities that you might have, there's also the issue of if I invest in a portfolio of mutual funds or ETFs or something like that, I've got a lot of diversification, lots of different types of companies and so forth. If I sink, say, $200,000 in this property in my region, I'm inherently less diversified. How should people approach that issue?
It's a big problem because typically people have the biggest part of their net worth in their house. It may even be
in the house that I live in.
The house you live in, and that is in itself, although we try to dissuade people from thinking about a house as an investment, it's really a piece of, the rock.
Your net worth, at least.
It is usually as much as 60% or more. So if you then spend another $200,000, you may be overweighted in real estate. So you have to think about that. On the other hand, if you are able to generate the income, and let's say you buy a $200,000 house, you don't need a mortgage for it, and your money's been sitting in a bank account or in a CD earning maybe 1-2%, and you're going to be able to get an 8 to 10% return on that money. Yes, you're over-leveraged in real estate, but you're generating real income, and it's something that's a great hedge to a market collapse, for example. People are going to need to live somewhere, and renting is on the rise. Home ownership has been on the decline. And rents are rising, especially in comparison with income. And so you've got a sense where you have to look and see what is available in your marketplace. Where we're seeing a lot, when I look out at the markets and I talk to the economists and housing people, where we're seeing a lot of juice in the industry right now is with multifamily. So Fannie Mae had just announced a brand new program, I think it was Fannie, where they're going to give steeply discounted loans to developers who want to build multifamily, who want to devote, for the life of the property, a percentage to affordable housing. There are some still Section 8 and other kinds of benefits and perks to building affordable housing. And if you're inclined to sort of build something rather than renovate something, or even if you renovate, let's say a small apartment building with 4 units, there may be some additional tax benefits to consider that would make it a worthwhile investment for you. So there's a lot of different ways to look at these things. But let's say you don't want to actually start bricking things up and painting windows and actually screening tenants. There are ways to invest in real estate investment trusts. Those have been a little bit on the decline. You have to look at what kind, whether you go with mortgage-backed one or you're in one that's more retail-oriented. I'd be careful there.
You can buy a fund or an ETF that's devoted to REITs too.
You absolutely can. And you may actually run across somebody who's buying a small building and they're willing to sell you a share because they're syndicating it, or you've got a partner that you can go in with. One of our properties, we actually did go in with a partner, another real estate attorney, and that's worked out just fine. I mean, we didn't think it would for a while, but then it did. And so the one thing I would caution people is that this is not for the faint-hearted, and it's not something to be entered in casually. So take your time and do your research.
Okay. I guess one universal rule that applies to investing is that you don't want to be buying at a really high point in the market. And I think
Do you know when that is?
I don't. But the question is, we've seen some markets really heat up in certain parts of the country. I know that it's sort of human nature to think this is a good time to buy after we've seen a lot of price appreciation. How can you protect yourself against buying at a high point?
So one of the things that I learned a long time ago from studying the marketplace is you never really want to lead a neighborhood. And by that I mean, you look at a neighborhood and you look at who's living in that neighborhood and who's attracted to that neighborhood. And if you see houses that are priced above what those people can afford, even with today's low interest rates, that neighborhood's going to come down in price, or it's just going to stay flat until the market sort of catches up. And you have to be really, that's the level of detail and research I want you to do. You have to talk to agents and see what properties are going for in terms of renting.
Right.
You have to really understand what the costs are going to be to fix it up. And so when you are making that investment, this is truly a place where it's not enough to check the box, oh, I think it's going to work. You can lose a lot of money fast investing in real estate if you're not careful. And yes, property prices have risen very quickly. Personally, I would never invest in Palo Alto, California, right? I mean, a tear down is now $2 million.
Right.
But I sure wish I had bought 10 years ago, like our friends, because their house has tripled in price in 7 years. And a nice little one-bedroom house across the street is selling for $2.5 million. That to me is beyond comprehension. And so if you're in a situation where you don't understand what the numbers look like and you can't possibly imagine it, step away. There's lots of other places to go. I would recommend you might want to look at a HUD home. HUD homes are, of course, FHA foreclosures. People go, things happen. But at HUDhomestore.com, which is the federal government's website for HUD homes, you can find HUD homes that are in neighborhoods across the country that you may be able to get for a very favorable price, and then be able to find people who want to buy those HUD homes or rent those HUD homes from you. And that might be a good place to start.
Okay. One other question is, we've seen mortgage rates lift a little bit over the past year. They're still pretty low by historic norms. Yeah. How should that factor into the calculus, if at all?
Again, what is it going to cost you to buy the property, finance the property, fix up the property, find the tenant, pay the agent, and then what are you going to take home at the end of whatever tax deductions are left?
Does it need to be cash flow positive on day one, year one of my...
if it could be, good for you, right? I mean, I would love that, but mine...
Not necessarily the case.
No,
okay.
Mine haven't been. On an after, on the two that we have left now, on a pre-tax basis, one is now profitable, but we've had it for almost 20 years. And that mortgage is way paid down. And, we're clearing a really good amount of money every month on that. But it wasn't cash flow positive to start. The other one has sort of been borderline. Some years it has been, some years not. When we sell it, we'll have a huge deduction and recapture we'll have to work on, but we'll end up making money from that. And so I think the message here is this is not a quick thing.
Yeah.
All the HGTV shows that you watch, they all seem to have happy endings. I'm here to tell you that when it comes to investing in real estate, if you want it to work out, time is your friend.
Elise, always great to get your insights. Thank you so much for being here.
It's been fun.
Thanks for watching. I'm Christine Benz for Morningstar.com.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Next, a tug of war in the bond market.
I'm Elena Bompieri with Morningstar. I'm joined by Mary Ellen Stanek, Chief Investment Officer of Baird Advisors. Mary Ellen, thank you so much for joining me.
Thanks, Elena. Great to be here.
So the U.S. bond market has had many different things thrown at it this year, from the Fed continuing to raise interest rates, to strong U.S. economic data and a strengthening dollar, to more recently tariffs. So I'm wondering, what should long-term bond investors really be focused on right now?
Well, so bond investors, we always step back. Why do people own bonds? They own them for the predictability, the consistency, the cash flow or income. They want to lower overall volatility of their total portfolio. So what we want to do is make sure we execute strategies that provide that consistency and predictability that investors desire. So there's plenty of things to think about right now in terms of the economic landscape, the capital market landscape, the global landscape, lots of things. But we'd set it up as a tug-of-war right now between the cyclical forces here in the U.S. that are strengthening and actually creating a pretty good economic environment with those secular headwinds that are certainly going to dampen economic growth.
So Baird Aggregate Bond and Baird Core Plus are both kept duration neutral to their benchmarks. And so I'm wondering what your thoughts are on where it's worth taking risk right now. High yield has continued to do well this year, albeit not with the same momentum that it had performed last year and in 2016. Investment grade struggled at the start of the year. So in those funds, with setting duration aside, where do you think it's worth taking risk?
So we stay duration neutral because we don't believe we can consistently add value that way, and most investors don't add value that way consistently by trying to forecast interest rates and move duration around. So that said, we neutralize that decision, and then we spend our time and attention on yield curve positioning, sector allocation, individual security selection. So how do we build the portfolios to try to outperform their benchmarks and pay for our expense ratios and then some? We do it a couple of ways. One thing right now that we're doing is underweighting our agency pass-through positions. We've got about 75% of the weight of the benchmark in what is a very big sector for the benchmark. And why are we that underweighted? For us, that's a pretty significant underweight, and we've had that on for a while, is because as the Federal Reserve continues to normalize their balance sheet, we believe that there will be underperformance in agency pass-throughs. So how do we fill that bucket? We overweight credit, although we have been reducing that overweight slowly over time, but we are still overweight credit. And then on the mortgage-backed and asset-backed side, certainly asset-backed securities, commercial mortgage-backed securities, all very high-quality senior in the capitalization structure. And we have slight yield advantages on the portfolios, but we think we're in an environment where managing risk carefully is going to be very important. But we are not battening down the hatches on the credit side. We still see fundamental value there, and in fact, many of the fundamentals are actually encouraging.
The two funds, Baird Aggregate Bond and Baird Core Plus, both maintain mostly exposure in investment grade bonds with little and below investment grade. When you look at, where opportunities are in investment grade, what sectors or credit qualities stick out to you as places for opportunity? So the difference between the two funds is in the Core Plus fund, we can own up to 20% below investment grade. Currently, it's less than 6%. It's about 5.5% or so. And that's equally split between non-agency mortgages and high-yield corporate, primarily fallen angels. We are underweight the benchmark there, and we're underweight what we could do because we want to keep powder dry. We think that, as your question suggested, below investment grade has had a very good run. Spreads are tight, and while we think this economic cycle has a ways to go, and the environment actually is quite constructive, we don't think generally we're being paid to take that risk. Spreads are quite tight relative to historical averages. So we see better value in carefully well-diversified, carefully selected, well-diversified BBB, and have overweights there, but well-diversified, and tend to own our exposure short and intermediate in those portfolios. Okay, great. Well, Mary Ellen, thank you so much for sharing your views with me today.
Thanks, Elena.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
And finally, an upgrade for this solid small cap fund.
We recently upgraded JP Morgan Small Cap Equity to silver from bronze due to the strength of its lead manager investment process. Don San Jose has managed the fund since 2007 and took over his lead in early 2013. Alongside a compact supporting team of 3 seasoned analysts, San Jose seeks small cap companies with durable competitive advantages and sustainable cash flows, usually between $1 and $3 billion in market cap. This search for stability leads the team to favor areas such as industrials and materials over more speculative areas like biotech, which combined with a low turnover approach gives the fund a larger cap bent and heavier exposure to firms with Morningstar economic moat ratings relative to small cap peers. Now, the fund also courts price risk as San Jose is willing to hang on to winners from small to mid cap territory, but its profitability metrics remain superior to peers. This focus on quality is evident in the fund's returns since San Jose assumed lead duties, as it beats the Russell 2000 index in small blend Morningstar category with less risk, which is notable given the fund's technology underweight. Further aided by below average fees, the fund, which closed to new investors in late 2016, is a solid small cap option.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.